Hello and welcome. We started financial statements, preparing financial statements and the meaning of them and why we should learn about finance in the previous session. We will make a quick recap on that and then move forward quickly. Understanding financial statements is very important because we have seen many companies are running out of cash. They did not plan in advance, that is why suddenly they realized that there is no cash to continue. So, they had to close door. So, if they would have understood at the beginning that there is going to be a cash issue moving forward, they could have taken preemptive action and then could avert failure. There is a saying that if one does not understand finance, then cannot manage a company, cannot manage a business. So, it is perhaps a succinct way of saying the right thing about knowing finances. I mentioned about global accounting standard setting institution. One is IASB, International Accounting Standard Board, that kind of set the standards for almost all the countries in the world except US. For US, there is Financial Accounting Standard Board. In India, we have Institute of Chartered Accountant of India, who are kind of a arm for Government of India to take a cue from International Accounting Standard Board and decide whether they should adopt whatever policy that are coming from the International Accounting Standard Board, and that is how we work. We also discussed about operating cycle, and we explained why operating cycle is so very important. Definitely you remember that this starts from cash and then it goes through purchase of material, then you convert them into finished goods, then you sell them. When you sell, you do not actually get cash, you sell them on credit. After a while you collect cash, after a while means after a few days or maybe months sometimes. When you collect cash, it gets converted into cash. So, this whole thing, cash to cash cycle, is called operating cycle, and the time taken to complete this cycle is operating cycle time, or name anything, but then this cycle time is very important. Suppose your cycle time is 6 months. So, you are turning your working capital 2 times. Now, if you can really reduce that time to maybe say 3 months, then you can turn it 4 times. So, every time you turn it, you actually you sell everything that you produce. So, your turnover goes up, and then your interest cost is reduced because you are using the same working capital for a shorter time. Now, you have 4 turns, and every time you are making gross profit margin, and from there you are paying the interest. The philosophy, one of the philosophies of lean manufacturing is about reducing your inventory of raw material and finished goods. So, you buy raw material whenever you need, something like just in time inventory management. Similarly, you produce and you produce as per orders in hand. So, if you have order, you just produce and let it go to the buyers. You do not hold. So, your requirement of working capital will go down, and you will end up paying less interest, and you will end up making much higher turnover with the same amount of money or lesser amount of money. We discussed about double entry system. I will just elaborate a little bit. In double entry system, you have for every transaction at least 2 accounts get impacted, or maybe more than 2. So, I have an example of 3 accounts getting updated or getting changed. Suppose you buy some raw material, or say material and raw material. For manufacturing, they call it raw material because that is converted into finished goods. For retail or any other company where you do not really convert anything, you might very well say materials. Say raw material, let us call raw material. So, suppose you buy raw material worth of rupees 100 and you pay partially in cash, maybe say 40 rupees in cash, and you keep a credit of 60 rupees, meaning that you want to pay the 60 rupees later on. So, you see, your raw material is going up because raw material is coming to your go down, so that goes up. You are paying cash of 40 rupees. So, from your bank or from your pocket, 40 rupees goes out, and then because you have to pay 60 rupees later, so you are creating accounts payable, meaning some credit. So you have a books of account, you have a book, general ledger called accounts payable, where 60 rupees goes up. So 3 accounts gets affected. Here is how they are shown. So pause it a little bit and then you can understand. Now we discussed about debit credit rule. I mentioned that whenever through some transaction, if any asset goes up, then it is debited. Asset going down, it is credited. If you make some income, the respective ledger, say sales ledger is credited. If some expenses are incurred, suppose you pay a salary, your salary account is debited. So you remember this 4 should be good enough. So taking cue from the previous example, you can see the debit credit that happened there. I am not going into details of this debit credit thing, because we are not in an accounting class, number 1. Number 2, that would be too very involving, and you will have to remember so many things that you will lose interest in the remaining part of the financial statements. So it is not so much necessary, but then how the accounts get impacted is very important to know, because at some point of time you will have to cut cost to make your company more profitable. So you need to know what is the implication of different entries. 3 major financial statements: balance sheet, profit loss account, and cash flow statement. So I mentioned about balance sheet that it is a snapshot at a point in time of your assets and liabilities. So whatever assets you have and whatever liabilities you have, at a certain point of time you take stock of the thing and then you present that in the format of a balance sheet. So you have the total assets and you have the total liabilities. I mentioned that assets are the application of money or fund, and liabilities are the sources of money or fund. Suppose you have fund is more appropriate, because it is not always money that creates asset. Sometimes actually fund creates. The difference is like this: suppose you buy raw material on credit, and you are actually not paying any money, but then you get assets that enhances your total assets of your company, so, and in the balance sheet. So it is fund actually. Fund means it may not be cash, but it's money equivalent. So money plus money equivalent together is fund. So balance sheet actually represents your total fund. Asset is the total application of fund. Liabilities are the total sources of funds, maybe different kinds of funds, and that gives a holistic picture about your business. Profit loss or income statement used interchangeably. So profit loss statement actually refers to a period of time. It starts from some point in time, it ends at some point in time. In between, whatever operations you do, whatever profit you make, whatever expenses you incur and whatever income you earn, everything together you make a consolidated statement to understand how much profit you made and how much tax you have to pay, how much money you can take home or do whatever, means you can plan accordingly. So it refers to a span of time. So it starts from some point in time, ends in another point in time. It is happening over a period of time. Cash flow statements also happens over a period of time. It gives a holistic picture again about the net cash inflow and outflow, meaning net cash flow from cash inflows and cash outflows. In any business, cash goes out, cash comes in. When you earn something, cash comes in. Suppose you are selling goods, cash comes in. Suppose you are incurring some expense, then suppose you are paying salary, cash goes out. So eventually there will be, you will find that many times through many heads cash is going out, and through many heads cash is coming in as well. Cash comes in through very limited number of heads. Suppose you have only sales and no other income, then cash will come only through sales. But suppose you have some other income like say job work or consultancy or anything that you do for others. Suppose you sublet portion of your office, you earn some rent, or you make some investment in a bank, so you earn interest, that also cash inflow. So, total cash inflow, total cash outflow, net amount is the cash flow in that period, and many a times actually companies do not realize at the beginning itself that their cash flow will be negative at some point in time. The moment it becomes negative, it becomes very difficult to continue, because everybody, there will be pressing demand from everybody whosoever are supposed to get money. So, you have to understand well in advance when you are going to be cash negative, so that you can arrange money well in advance. Cash flow happens from means all the cash flows are categorized or classified into 3 different groups. One is operating activities, that is from sales, purchase, etc., etc. Net profit is the main thing here. Then whatever your current assets and current liabilities, that is going up and down. So, depending on whatever is the net position that comes in, and then if there is any non-cash expenses, that is also added here, like depreciation, amortization. Other part is investment activities. If you procure some fixed asset, that falls under investment activity. You can also make some investment like in bank deposit, or say you buy some equity from some other company. Financing activities are like you raise loan, or you give loan to somebody, or you repay some loan, etc., etc. Use of cash flow statement for a startup is very important. I have been continuously emphasizing that. So, let us not waste a lot of time on that. It is very important, otherwise it may be fatal at some point of time. Many companies actually fail because they did not look at cash flow. There are many examples. I do not remember the name, but I was just talking to somebody, and he mentioned that there was a company, is a real company, and he was talking, the CEO was talking to a friend who is a management graduate, and the CEO of the company was saying that, you know, we are doing pretty good, or presently we are earning profit of this amount, it is a hefty profit. Then the other friend who is an MBA, he said, give me some more data, let me see. So, over a cup of tea, he just scribbled some data, and he said, you should be very careful. You are going to be cash negative 6 months from now. He said, what do you talk about? We are making so much of profit. Just almost like he said, go to hell. Then after 6 months, it actually manifested, and he telephoned, and then he realized what is the importance of finance. So, he did not understand that he is selling goods and he is making profit in the books. Money is not coming. So, gradually it is piling up. At some point of time, he realized that money is not there. So, he cannot pay salary, something like that. It's so very important. Now, we will move into the real example about profit loss account and balance sheet. I will walk you through some example, very simplistic example. We will not discuss in detail. Majority of the items will be just, I will make a fleeting remark or maybe little bit of definition, because financial statements contains several new jargon, I won't say jargon, they are new items. So, defining everything together is going to be difficult. Like say, I won't define depreciation for the time being, I will just explain what it is, but then there are definition of depreciation, there are methods of depreciation, which we are going to discuss moving forward one by one very explicitly. Today, this time we are going to discuss I am just going to walk you through the process, so that you have a bird's eye view about things. Suppose the best part about or the best context of financial statement should be a retail trade business. Suppose you buy something and you sell that. It is like suppose it is a ready-made garment business, or say a grocery store, or say a stationery shop, something like that. They do not manufacture anything, they just procure material, store them, hoard them, and then from the other end they just sell it. So, it becomes kind of a simplistic context. So, suppose you are I would like to give an example with which you can connect well, so that you can have a holistic picture. So, suppose you are residing in a hostel, majority of you perhaps at some point of time resided, or you are residing in a hostel. So, in your own room, suddenly you think that okay, we people talk about entrepreneurship. I am not really into the entrepreneurship as yet, but let me see how business operates and let me make some quick money just for fun's sake. So, you think that there are maybe some 300 odd students in your hostel. So, you thought that okay, let me buy some stationery items, and then let me see whether students will be buying it from me and how much profit can I make. So, you go to a larger city and then procure stationery and then keep them in your hostel, and students comes in the morning, they come in the morning, they come in the evening to buy, and you sell. Suppose you bought some 50,000 rupees worth of stationery, and during the entire period, say it is 3 months, 4 months, 6 months, forget about the period for the timing, I am not even referring to a financial year. So, you bought 50,000 worth of goods. At the end, when you have sold everything, you found that it is 65,000 rupees for which you sold, and nothing is left. So, your closing inventory is 0. Whatever remains after a period is closing inventory. So, we will define that moving forward, and in the next period this closing inventory becomes the opening inventory for the next period. We will explain that. Now, in this period I will just define what is gross profit. It is a new term, and know for sure what is gross profit with this slide. Gross profit is your sales minus cost of goods sold. Now, as I said, for a retail store it is very simple. Gross profit is equal to sales minus materials consumed. Materials consumed means whatever you purchased at whatever price, whatever cost. So, total you have invested. In the same example, you bought items worth 50,000 rupees and you sold them for 65,000 rupees. So, here your cost of material or raw material consumed is 50,000 rupees, because nothing is left. Now, suppose hypothetically, I am not talking about this example, suppose at some point of time you observed that there is a stock of 1,000 rupees. So, if 1,000 rupees worth of stock is still remaining to be sold, that means you have sold items that for which the cost was 50,000 minus 1,000, 49,000. So, that would be your cost of goods sold, but for this simple example nothing is left. So, entire 50,000 rupees worth of stock you have sold, and 50,000 is the purchase cost, the expenses that you incur for buying them. By the way, expense and expenses are two slightly different things. Expenses are kind of an umbrella term, like whatever you spend to buy anything, that is expenses. But if you buy something that you consume during the year as part of the business, then it is expense. And if you buy some fixed asset kind of a thing that remains with you, that is expenditure. So, everything is expenditure, expense also is expenditure, that is an umbrella item. Under this umbrella, expense refers to items which are consumed as part of your business. Okay, that apart. Now, gross profit is equal to sales minus cost of the material consumed, and we have consumed 50,000 worth of material and our sales is 65,000. So, 65,000 minus 50,000 is 15,000. There is a typo actually. I was working on 75,000, but later on I wanted to make it 15,000. So, forget about the 75,000, it is 65,000 minus 50,000. So, result is 15,000 rupees of gross profit. Now, this is a proprietary business because you are alone and you are the proprietor, whether you form a farm or not, immaterial. Only thing is that you must have a trade license. So, do not try this just like that. Unless you have a trade license, this is illegal business. Whatever you do is illegal. So, you must have a trade license. So, do not try that without a trade license. So, suppose whatever is the case, suppose there is no other expenses, no other expense, and these are the only expense, and because it is proprietor, I suppose we have already covered that proprietor's income from salary or any other income and from business are clubbed together for income tax purposes. If you operate a limited liability company, that becomes very different. Here is the difference. For limited liability companies, 15,000 rupees will also be taxed, whereas for proprietor it is like salary income. So, there will be a slab, and after 2,50,000 rupees there will be no tax at all. So, 15,000 rupees there is no income tax. So, everything is your profit, you can take home. So, you have decided that okay, let me spend 12,000 rupees for my personal expenses and let me keep 3,000 rupees for future perhaps. Now, you realize that this is fun actually. I made 15,000 rupees just like that, sitting here and operating it morning and evening. It gave me good profit. So, maybe I can do it more formally and then I can generate some capital, and then in future maybe I can start an entrepreneurial venture. So, you decided that okay, let me see how to scale up this operation. So, you started estimating as to what should be my expense or what should be my total cost of a project for starting this a nice formal stationery shop in my hostel itself. So, first thing is to understand the total requirement of money for a business, whether you start a stationery shop or you start a grocery shop or you start an entrepreneurial venture. You need to understand what is the money that you are going to require. Suppose you are going to approach to an investor, you have some idea and you have developed a prototype, some minimum viable prototype, and then you would like to approach, you have already got it customer validated, you want to approach to an investor. Now, investor will say how much money do you need? Then you say $1 million or say $1 lakh. But he will say how do you arrive at that data, at that figure? Why 1 lakh? Why not 1,05,000? Why not 95,000? So, you need to come up with some data that you can explain that this is the calculation, and this I feel can take us to the next round, meaning that you should ask only that amount of money that can take you to the next stage. You define your stage, maybe that will be you take it to innovator kind of customers, and then next stage you define as early adopters. So, it is kind of a that is your definition. You can say that okay, we want to get 100 customers, we want to get it trialed by 100 customers, that is our first phase. Once 100 customers out of 100, maybe 80 will say yes, this is the product we are looking for, then we move to the next round. That definition is yours, but suppose something like that. So, you need to estimate how much money you need for making those 100. Now, here for this stationery shop, you have decided that at the very minimum I need a counter. So, that when people will come, it looks like a formal shop, not really they walk into my room and then they kind of soil everything and then products become old, etc., appearance becomes old. You need a chair, you need a rack to keep things in an order. So, you need these items. Subtotal of that is 1,500 rupees. Then you need to keep more raw material, meaning stationery items. What do you buy? You made in a kind of a scribble pad, you have scribble item that I need this amount of pen, these notebooks, etc., etc. So, I need 5,000 rupees worth of stock. Then somebody comes with 500 rupee note, you need to give him change, him or her some change. So, you need some cash. It may not be 500, I just put it 500. There is no relation with 500 rupee note and 500, some cash, loose cash that you want to keep for giving change. So, 500 rupees cash plus 5,000 rupees, these 2 together is 5,500. Notice carefully that I have kept these 2 together and the other 3 together separately. Why so? Because their nature is different. Why? How? The counter, rack and chair will remain with you as long as the business runs, as long as you want to run the business. When you leave the hostel, you may very well like to sell the business to somebody else. That is your that is a decision that you will take later, not now. So, as long as you run the business for 2 years, for 3 years, for 4 years or 5 years, you are going to keep those items with you. These are referred to as fixed asset. Why they are asset? I said anywhere you invest money to procure are asset. You have spent 500 rupees, 600 rupees, 400 rupees, meaning 1500 to procure counters, rack and chair. So, these are assets because you have invested money to procure them. This is application of money or fund. And these items like pen, folder, pencil, etc., these are items that you would like to sell. When? As quickly as possible. If you can sell 5,000, entire 5,000 worth of goods today, just now, you will be the happiest guy. You will run again to the marketplace to buy, to replenish your stock, and again you will sell. So, you sell 5,000 worth of goods every day. That gives you a wonderful profit, wonderful turnover, and then eventually profit. So, these are the items that you would like to sell as quickly as possible. Are these constitute something called current asset or short term asset. Those are long term asset. The things which are short term in nature, they are short term asset or current asset. It's a terminology that accounting people refers as such. So, here are some good philosophy about fixed asset and current asset. This is to be remembered. So, we are just moving deeper and deeper with different terminologies. So, long term or fixed asset, short term or current assets. Now, you have a fair idea about these two. All the above assets of your business at the top are the long term asset. It is an explanation, you can just go through. I will not waste time on this. Short term asset are those assets which you keep for a shortest possible time in your business. They are part of your operational activity, meaning whatever you sell, they are part of that. It is not exactly that way, meaning short term asset may be, say, accounts receivable. You have already sold. Now, you have to recover that money. So, this asset lifetime, the shortest is the better. Shorter it is the better, meaning if you can collect the money today, you will be happier than you collect it tomorrow. So, similarly, whatever explanation I have given. Now, how to arrange this money, from what source? If you had what money we need something like 7,000 or so. So, total of 7,000. So, we need 7,000 rupees, but you do not have 7,000. You saved only 3,000 from your previous venture, meaning previous whatever you did. So, you need actually 7,000. Now, you explore, bank will not give you a loan for starting a business in the hostel or even wherever. For a 7,000 rupees, bank will not give loan unless you are under some kind of a scheme, like some kind of a scheme. There are government scheme. Forget about that for the time being. We will discuss that when we talk about funding, means government schemes for entrepreneurs. There are many schemes where you get lots and lots of money, grant as well as soft loan. Now you need 4,000 rupees for extra rupees to start the business. You have 3,000, 3 plus 4, 7,000. Suppose you get this money from a friend, say somebody by the name Jack, and you get this money from him. So, you have 7,000 rupees, you start buying these racks and tables and chair, counter and chair, and you procure this material. Then this you could have prepared even before arranging the money. Suppose Jack tells you that you want 4,000 rupees, show me how you are going to tie up the entire business, then I will give you the money. So, you can very well prepare a balance sheet. Suppose you are preparing a balance sheet as on 31/3/2017, when you are talking to Jack that today you give me the money, tomorrow I start the business. So, you tell him that I need cash of 500, I need say inventory of 5,000. Inventory means raw material, finished goods, goods in process, stock of all of them together called inventory. So, you can very well say inventory of raw material, inventory of finished goods, but then normally people write inventory as an umbrella item, then they write raw material this amount, goods in process this amount, and finished goods this amount. So, total everything together they write, but ours is a retail trade business as of now. So, we are not actually going into all those classifications. Now, we are into balance sheet actually. So, lots have to be talked about balance sheet. I will just introduce some of the items in balance sheet, define the balance sheet. As I mentioned earlier, balance sheet is a snapshot as on a point in time. So, here I wrote balance sheet as on 31/3/2017. It does not mention a time, but implicitly the time is mentioned. Time is as on the close of business on 31/3/2017. Ideally or even officially or theoretically, it is actually 12 midnight of 31/3/2017. Cross that point, it becomes new year, new financial year. So, up to the beginning, up to the end of the old financial year, the point in time, not up to, point in time is that 12 midnight 31/3/2017 is the balance sheet date. You say balance sheet as on 31/3/2017, implicitly you say as on the close of business. Now, balance sheet has two sides, assets and liabilities. Earlier days people used to show these on two sides of the sheet, that is why it is balance sheet. Liabilities used to be on the left side, assets used to be on the right side, maybe something like 15-20 years back. But now majority of the countries follow a vertical column format of balance sheet, where people write assets first, then they write liabilities. So, there are two items. Normally people call liabilities and owner's equity instead of saying liabilities. Earlier people used to say liabilities, but liabilities now have two components. One is liabilities per se, another is owner's equity. So, these two together forms a block, liabilities and owner's equity. The other block is assets. Now, assets are of two types, mostly two types. One is current assets, which are current in nature, meaning that their lifespan is shorter than 1 year. So, they are normally meant to be liquidated as quickly as possible. Another is fixed asset or long term assets, which are supposed to remain with the business for some time. Now, the convention of mentioning them or placing them is like this. The most liquid items are mentioned at the beginning. So, it goes in this serial or this sequence. The most liquid item is cash in case of asset. Cash is most liquid because cash means anything that can be converted into cash. The way means that the ease at which something can be converted into cash is liquidity of that asset is the kind of, that is the term. So, cash is liquid already because it is already cash. So, cash comes first, then comes accounts receivable, because you have already sold some item and you are yet to receive the payment. So, to whosoever you have sold the item, their name, maybe company name or individual's name, remain in your books of accounts as accounts receivable. Those are the parties, those are the items that for which you have already sold and you are supposed to get money. So, that is slightly more liquid then inventory. Inventory is you are holding the either finished goods or raw material. So, that is to be converted into finished goods, then you have to sell them, only then they will become liquid. So, cash comes first, then accounts receivable, then inventory. Again I am repeating, accounts receivables, receivable are those items which are generated through sales. You sell something, you are yet to receive the payment, that is why it is receivable. So, whatever amount you are supposed to receive from various parties, aggregate of that is here as 5,000, sorry, there is no data, is 0. So, that is accounts receivable. So, entire receivables are reflected in account receivable. You will have a separate ledger where the names of all the parties will be written. Next major item in asset side is fixed asset, where you start with the most liquid again. So, here the liquidity is not so much pronounced here. So, fixed asset is fixed asset, they are not liquid. So, normally you start with land. You can write land at the end also, because land normally people do not sell, even machinery may sell if they become old. Whatever is not, you do not care so much about this, at what order you write fixed asset. So, what you have here is land, then building, then factory shed, office complex, machineries, whatever machinery, sorry, machinery is a singular item, machinery, then any furniture, fixture, then anything that you do not like to sell. These are all fixed asset. In liability again, then you start with accounts payable, because this money you have to pay immediately. So, that comes first. Then if you have a bank loan, so short term bank loan, we will define short term bank loan later on. For the timing, you know that there are two kinds of bank loan, one is short term, another is long term. Short term bank loan is given for purchasing current assets like say stock and whatever is your working capital. I mentioned about working capital cycle or operating cycle, whatever money you need to maintain that cycle. If any bank fund is available to maintain that or to augment that fund, that is short term loan. Bank also gives you loan to buy long term asset like say machinery, like building, those are long term bank loan. They are repayable over a period of time. And then last is owner's equity, meaning that if you bring some money to the business, that is your equity. So, owner's equity comes last. So, you brought 3,000 rupees. So, owner's equity is 3,000 rupees. So, asset size total is 7,000. That are the things you want to procure. How you source, where you get the money? You get the money from the liability side. So, 7,000 worth of asset you want to procure, and you already have shown that 7,000 rupees are there if I get 4,000 rupees of loan. So, remember that assets and liabilities will be always the same, because assets are the application of money, liabilities are the sources of money. If you have not been able to use the money as yet, that they will remain in the form of cash. So, cash plus other assets together should be funded through liabilities. So, these two together combined together to balance the balance sheet. We will close this session here, and moving forward we will talk about profit and loss account and cash flow statement.